Somewhere right now, someone is refreshing their portfolio for the 10th time today. The market dropped 2%, not 10, not 30, 2. But their hands are shaking anyway. Why does a small drop in a number on a screen feel like the floor is collapsing beneath you? The answer isn't really about money. It's about a pattern buried so deep in human behavior that it has caused the exact same disaster over and over for nearly 400 years. Different decade, different asset, same script every single time. And once you see the pattern, you'll never watch a crash the same way again. Let's start at the beginning. In 1637, in the Netherlands, people were paying more for a single tulip bulb than for a house. Historian and economist Charles Mackay documented this in the 1800s, and it became one of the first recorded examples of what we now call a speculative bubble. Prices didn't rise because tulips became more valuable. Prices rose because everyone believed prices would keep rising, and that belief became the entire engine. Then it collapsed in weeks, not months. Weeks. Fortunes vanished overnight, and historians still argue about exactly why the panic spread so fast. But the pattern was already visible. It would repeat again, and again, and again. Fast forward to 1929. The stock market had climbed for years. Everyday people, not just bankers, were buying stocks on borrowed money, convinced the climb would never stop. Then in October, over the course of a few trading days, the market lost around a quarter of its value. The crash helped trigger the Great Depression, a decade of economic devastation that reshaped the entire world. Now here's the question almost nobody asks. Why do intelligent people, again and again, across centuries and continents, walk directly into the same trap? Economist Robert Shiller spent decades studying exactly this question. He won a Nobel Prize partly for his work, showing that markets are driven far less by rational calculation than most people assume. Shiller found that price bubbles form through something he called narrative economics. A story spreads. Tulips will make you rich. Tech stocks will make you rich. Housing never goes down. The story doesn't need to be true. It just needs to spread faster than people can question it. Does that sound familiar? In 1999 and 2000, the story was the internet. Companies with no profit, sometimes no actual product, were valued in the billions because investors believed the internet would change everything. It did change everything, eventually. But that didn't stop the Nasdaq from losing nearly 80% of its value when the dot-com bubble burst. The technology was real. The story just got ahead of the reality. Here's the deeper psychological mechanism underneath all of this. Psychologist Solomon Asch ran a famous experiment in the 1950s that had nothing to do with money. He asked people to judge the length of lines on a card, a task so simple a child could do it correctly. But when he placed actors in the room who confidently gave the wrong answer, about a third of real participants changed their correct answer just to match the group. Think about what that means. Humans will override clear evidence in front of their own eyes, just to avoid standing apart from the crowd. Now put that same instinct inside a room full of investors watching prices climb. Nobody wants to be the only one who didn't buy. Nobody wants to be the only one who didn't sell. The fear of being wrong alone is often stronger than the fear of being wrong together. This explains the climb, but it doesn't fully explain the fall. For that, we go back to loss aversion, the finding from Daniel Kahneman and Amos Tversky, that losses hurt roughly twice as much as equivalent gains feel good. During a calm market, that imbalance sits quietly in the background, but the moment prices start dropping, it takes over completely. Here's where it gets stranger. In 2008, during the global financial crisis, the market didn't just fall because home loans failed. It fell because fear itself became contagious. One institution's panic triggered another's. Selling triggered more selling, not because the underlying businesses were suddenly worthless, but because everyone was terrified of being the last one holding the falling asset. The S&P 500 lost more than half its value from its peak to its lowest point. And then, in March 2020, it happened again. faster than ever before. In just over a month, the market dropped more than 30% as the pandemic began, the fastest crash of that scale in history. Not because anyone had accurately calculated the economic damage in real time. There simply wasn't enough information yet to calculate anything precisely. The market moved on fear, uncertainty, and the sight of everyone else selling at once. Notice the shape. Every single one of these events, the tulips, 1929, the dot-com crash, 2008-2020, follows the same two-part rhythm. First, a story spreads, and the fear of missing out pulls people in past the point that logic would recommend. Then fear reverses direction entirely, and the fear of loss pushes people out, often at the worst possible moment, selling low after buying high. The wild part is that the assets themselves are rarely the real story. Tulip bulbs are still just tulip bulbs. Most dot-com technology was genuinely revolutionary. Housing is still a basic human need. The crashes weren't really about the value of the thing. They were about the speed at which human belief can swing from certainty to panic, and how much that swing gets amplified once everyone starts watching everyone else. So what do you actually do with this? The first thing is to recognize that panic during a downturn isn't a personal failure. It's the same reflex that's shown up in every crash for 400 years. You're not weak for feeling it. You're human. The second is to notice the narrative you're currently believing, whatever it is. Every bubble runs on a story that feels obviously true while it's happening, and only looks absurd in hindsight. Ask yourself what story is currently driving your decisions, and whether you'd still believe it without everyone else repeating it around you. The third is simply time. Historically, markets that crash due to panic, rather than a fundamental collapse of the underlying economy, have tended to recover, sometimes faster than anyone expects. The people who suffered the most throughout history weren't usually the ones who stayed the course. They were the ones who bought at the peak of the story and sold at the peak of the fear. Somewhere right now, someone is refreshing their portfolio for the 10th time today. The market dropped 2%. But now you know what that drop actually is, not a verdict on the future. Just the oldest story in finance, wearing a brand new face.